Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today on our call, we have Gary Moss, the CEO of Yangaroo. Yangaroo trades on the TSX Venture Exchange under the symbol YOO and on the OTC under the symbol YOOIF. The company is trading at about 12 cents with roughly 60 million shares outstanding, or about a $7 million market cap. I'd now like to hand it over to Paul Andriola.
Hey, thanks, Trev. Yeah, great to have Gary here. I've spoken with Gary a couple times in the past. We've been following Yangaroo for a couple years. The last quarter, the company came off of a very strong quarter, so we really wanted to catch up with Gary and see where the business stands right now. So Gary, welcome. And as we always like to start off here, I'd love to have you just describe what Yangaroo is all about.
Thanks, Paul, and thanks for having me on this afternoon. Thanks everybody for joining. I'll sort of describe briefly what Yangaroo does, but I'll give you a quick sort of chronology of the company. We've been around for a while. It was formed in 1999, back in the days when music was going digital, and it was really started as a way of combating music piracy, and obviously the company has changed what we do and what the focus is since then. What we do now is we call ourselves a digital workflow solutions company, catering to the advertising and the music business, and we got into the advertising business about 7 or 8 years ago. Because there were parallels and similarities in the solutions that we could provide to those two industries. So people say, well, what is a digital solutions company? Simplistically, what we do is we deliver digital data from our customers to broadcasters. So I refer us, to ourselves as a digital FedEx, if you will. We receive digital data. It's usually commercials, songs, music videos, and we send that out to broadcasters, whether it be radio or TV. That's the simplistic version of what we do. There's a lot of complexity behind the workflows and the integration, with our customers and the broadcasters. But really, the complexity in the industry comes not from receiving the data and sending it out. It's really how the broadcasters receive the data and the way they want to see it. And this is where a digital solution and a pretty complex technology solution really was required. There's about 16,000 broadcast destinations, again, radio and TV in North America. And on the TV side of things in particular, there's about 8,000 or 9,000 destinations. Those destinations require digital files, so the video files, usually commercials, in about 500 different formats. So when you start to plot that out, you can, see that, when a single commercial goes out to thousands of destinations in hundreds of different formats, and that's got to happen in less than an hour, you need a pretty comprehensive technology solution. So, we've come up with a great solution. We can turn, those commercials and music videos around in less than an hour. It's a process that used to take, when it was a sort of physical medium, used to take days to turn that around. And we have a pretty elegant solution, and again, that's the distribution side, and then there are sort of logistics. I call it the logistics piece, where we provide some integration and workflow solutions, and we help companies become more efficient in the way this data is handled. Separately from the advertising and the music business, we also have a third pillar of the business, which is our award show business. And this doesn't work quite the same way as the music and the advertising businesses do. It's a bit of a standalone, but it still utilizes the same underlying platform where we manage submissions and review and voting on behalf of award shows. And we do, we have about 12 of the top 14 award shows in North America. So we do the Golden Globes and the Grammys, the Emmys, Junos, et cetera, et cetera. The only ones we don't do are the Oscars and the primetime Emmys. We do, there's about 3 or 4 other Emmys, daytimes, and things like that. So the award show business, it's a wonderful business for us. It's certainly prestigious. We've received a lot of credibility and marketing support out of that part of the business, and it certainly helped over the years when we were growing. You know, when you say that, you know, the Grammys is a client, it certainly adds credibility and gravitas to the story. So, you know, we compete in a market in the advertising side of the business, which is really the growth area of our business. There's 4 main competitors. The other competitors are bigger than us, certainly. But I'd say that we are more than competitive in terms of the technology, the broadcast footprint that we have and being able to reach everybody. And we certainly offer a superior level of customer service. So, you know, we're punching well above our weight in terms of the industry that we're playing in. But, you know, as our last quarter showed, we've been very, very successful. And I'd say we're one of the few companies, certainly, you know, with revenues at our level that are profitable and have been consistently profitable for a few years now.
Fantastic. A great summary, because I think you've answered 3 of my questions, so at least. So, so why don't you? It helped the listeners, I think, if you can walk us through the delivery of your service. So you've got a customer. Let's pick the music industry right now. You've got a customer that needs to have a piece of music or some audio delivered. Bring it from nuts and bolts all the way to that end consumer. What does that look like?
Sure. So, I mean, let's say you're an independent artist. You're sitting in your house, your studio. You finished your song and you need to get that out to radio and TV. So what you do is it's really simple. You can either download a manager onto your system, the Yangaroo interface, if you will, or you can upload your spot directly into our system with instructions of where you'd like that song to go in terms of radio and TV. So, and if you're not sure, you know, just get a hold of us, and you know, we'd certainly advise where we recommend that this song be distributed to. Once that song is uploaded into the system, and let's just talk about TV because it's a little more complex than a song on radio. So you upload your video, and you say, I want my video to go to all countries, you know, outlets across North America. The first thing we do is we take that video and we run quality control on it, because unless that meets broadcaster standards, it's not going to get played. So we run QC on it, make sure that all the audio video components and the sync is all in, meets those standards. And then we match it up with the distribution instructions that we've put into the system, and that song gets, the video gets distributed out to TV. That's the distribution side. Now everybody says, well, it's great that we sent it, but how do we know that anybody has received it and what they've done with it? So, you know, the back end of our system allows the user to, you know, to see who's viewed the file, and if they viewed it or downloaded it off the system onto their own, you know, playout service. Now, it doesn't guarantee that, you know, the video is going to get played at radio or TV, but it certainly is an easy way for your content to get exposed to the decision makers at radio and television. And then, you know, advertising works exactly the same way. You want a commercial played on TV, you've got a commercial, you've got instructions, which are called traffic instructions of where you want it to go. You upload the spot with the instructions. We take it from there. We, you know, QC it, make sure everything's okay, and then we distribute it out. And, you know, but more importantly for advertisers, we can provide the proof of delivery after the fact to make sure that it's got to the destinations that it needs to get to. Because in the case of advertising, obviously, if a spot doesn't make it, you know, depending on the time that you've bought, and if you end up missing time, it can be very, very expensive. So, you know, we're a small piece in the supply chain and the ad business, but if we mess something up and people miss airtime, it can be very, very costly. So, yeah, quality of service is paramount.
So, how much of this is automated? Like, how much hands-on is there? I mean, it seems to me that you've probably got some degree of automation in all this process.
It's 100% automated.
Okay.
So, you know, somebody uploads the spot, it hits our system, the QC is automated. Assuming everything passes that automated QC, it just goes straight through. So, you know, the process takes minutes. Now, you know, obviously, if there's issues with the spot when it runs through the automated QC, we have a QC team who will take that spot off of the automated system, pull it out, look at it, see why it's failed, help the client fix any issues, drop the spot back into the system, and away it goes. If a client has done the QC on their side and they want to bypass our quality control, then it's fully automated and it just runs through the system from end to end. And again, you know, we literally just make sure that it goes through the pipe correctly to wherever it's meant to go to. We get verification from the destinations that they've received it. And again, that just takes minutes to happen.
Mm-hmm. So I get the sense then you guys could scale very rapidly. Is there anything really limiting if you were to double or triple your throughput? What more would you need as far as being able to handle that?
Not much. And, you know, when we look back at our Q1, you know, the Q1 that we had, you know, we had the busiest quarter by far, and you know, by orders of magnitude. So, and we were able to handle that additional volume without, you know, hiring any more people. We certainly didn't need any more bandwidth or any more server capacity or anything like that. So, you know, we're at the point now where we could double or triple the revenue without any significant investment into the system or our infrastructure at all. Where things are less scalable is on the customer service side of things. You know, obviously, you know, you start to bring in, you know, significant new clients and the revenue increases significantly. You know, there is a level of customer service to help walk people through the system. You know, help follow up after the fact and invoicing and that kind of thing. But, you know, the beauty with our business is, you know, we're running at 95% gross margins, and that 95% will hold irrespective of where the volume goes. And, you know, we, as a rule of thumb, we say, you know, we probably would invest about $100,000 for every $1 million of revenue we added, you know, into the business. So, you know, margins drop to the bottom line pretty quickly. And again, you could see that in the Q1 numbers.
Mm-hmm. How do you price your service? And second part is, who pays? Like, who is it? Is it the content provider that pays you, or is it the content receiver that pays you?
It's the content provider. So, you know, it's the ad agencies that pay. Ultimately, they will charge the brands back. You know, so Toyota sends a spot to the agency is our client. Toyota ultimately, you know, pays the agency for the spot. And, you know, the pricing for the most part is on a per delivery basis. We do have, on the music side of our business, fixed fee deals. So, you know, really sort of recurring revenue deals. Our award show business is all recurring revenue, fixed, you know, annual fees. And on the ad side of the business, probably 20% of our revenue is fixed monthly fees as well. But the industry works on a pay-for-play basis. So, and pricing, you know, obviously depends on the volumes. and the size of the client and the business potential overall. So, no long-term contracts. It really is, unless there's an RFP that's been run, and you sign a deal for a year, something like that, which is unusual in this business, but that happens from time to time. It really is, no contracts, no long-term deals, no exclusivity, which sounds risky on the one hand. On the other hand, it's a business that's incredibly sticky because of the relationships and because of the integrated workflows. So, once you have fully integrated workflows, unless something goes really wrong, it's a pain to undo all of that. So, you very rarely will lose a client unless there's been a problem. So it's a casual relationship, but one that's very sticky and has longevity.
Okay, so we referenced Q1 a couple times here. It was a very good quarter for you guys, a record quarter, I understand. What happened? Why?
Two things. The growth came on the advertising side of the business. We were very lucky. We found ourselves in the middle of some very high volume U.S. political spending, and that certainly benefited us. It's important to note, obviously, it was related to a single candidate. It was Mike Bloomberg, who obviously most people know, spent like crazy. And when he dropped out, that sort of came to a standstill. It came through a political agency who are still our clients, but that business is very unpredictable. So that certainly accounted for a lot of that Q1 growth. But more importantly, if you exclude the U.S. political spending as a category, the underlying business was up 20% year on year. So, and that was across the board. It wasn't any, one or two other clients. It really was across the board. We had a few new clients come in that we signed in Q4 that started to get up to speed in Q1. So Q1 was ramping, very, very nice and healthy growth as well. Certainly didn't have the customer concentration in the 20%. And then obviously we had mid-March and the landscape changed pretty dramatically.
Okay, well, you led me right into the next question. So obviously COVID has changed the world. Certainly it's likely to change your industry as well. How has it impacted your operations? And then how has it impacted your outlook for the business?
In terms of the operations, it really hasn't impacted us at all. We're a technology company. Everybody's working off of a computer. So, we send everybody home. Actually, we sent everybody home about 2 weeks ahead of the work from home order because we figured it was coming. So we spent a little while testing, making sure that everybody could do their job properly. And, we really haven't missed a beat at all, operationally. We're still servicing clients. We're still distributing. Developers are still working. Everybody's doing, what they have to do. The area of the business that's had to adapt the most, I would say, is sales, business development, because obviously those face-to-face meetings aren't happening anymore. But after the first few weeks of everybody getting used to working remotely, that side of things has picked up as well. In terms of how it's affected the business, I mean, our business is down. There's no secret that advertising in general is down. We'll be releasing our Q2 numbers in the next few weeks. So I don't want to preempt that, but it's definitely impacted us. However, and I alluded to this in our Q1 MD&A, we're lucky. the industries that have been really hard hit by the pandemic, retail, hospitality, airlines, travel, that have really stopped advertising, almost completely. We don't have much exposure to it at all. So, we have a few healthcare companies. Our largest client is a car company. Their spending is off, but it certainly is still ticking over. So, we are still in business. Business levels are certainly at a point where, we're staying cash positive. We're not having to eat into our cash by any stretch. But we're being careful, certainly being careful on the cost side of things. Just by definition, expenses are down because nobody's traveling. So the whole sort of sales marketing side of things is quieting down. But it's quieter. But we are seeing signs of life over the last, let's say, 3 or 4 weeks, that some of the people that were, clients that were quieter are starting to jump back in.
I mean, I can imagine the advertising, if you've got political advertising business, I can imagine this next few months could get pretty interesting if the sort of spend that we can anticipate comes to fruition. So I'd be curious to see how that plays out. Well, listen, let's turn a little bit to your financials. Apart from your income statement, which obviously Q1 looked quite good, you guys are sitting with a pretty healthy balance sheet for a company your size. I see that you've instituted you had a share buyback in place. Do you feel comfortable with the cash you have currently to handle any kind of slowdown in business?
Yeah, we're sitting, at the end of the quarter, we had about $2.7 million in working capital, a couple of $1 million in cash. And we've managed to maintain that cash balance. So, as I've said, we're really not, having to eat into our cash resources to keep the business moving forward. So we're break even at worst on the cash side for now. And I'm pretty pleased on where we are. The share buyback that we instituted, we have put that on hold, just to be prudent with regards to the use of cash. So it's suspended. It hasn't been canceled, and obviously, when the time is right, the plan is to start that up again. But we have a line of credit with Royal Bank. It was $750,000. It's just been increased by the bank to $1 million. It's something that was sort of in play for a while. We're not utilizing that, but it's nice to have that as a backstop, if we require it. But I think more importantly, having the confidence of a Schedule A bank to start to give us credit, where in the past we've had to rely on high interest rate loans or debentures and things like that for our debt financing. Certainly says a lot about where we've come as a company and the state of the balance sheet. So that balance sheet is about as clean as it gets right now.
You'd mentioned that investing $100,000 for every $1 million in revenue. Where would you spend money if you really wanted to grow the business aggressively? Where does money get spent?
Where we've spent money over the last 12 months is really attending conferences, getting in front of clients. We've increased the size of the sales force a little because it's an industry that really leans very heavy on relationships. So people say, well, why don't you spend some of your money and hire a bunch of salespeople? In our business, unless you find salespeople who've been in this industry with a book of business, the lead time to develop those leads and bring them to the point of a deal could be upwards of a year. So, we have a small team, but a very, very effective team. We sponsor conferences, we attend conferences, we speak at conferences and on panels. So our profile, again, when I said earlier on that we punch well above our weight, it's the same thing in regards to the brand awareness of the company. The industry is certainly aware of us, certainly aware of what we can do, and we continue to spend time and effort in really on the branding of the company and on the general awareness. We've just completely redone our website, put a lot of good information on there. And I'd certainly encourage people to go and take a look at that. There's a lot of blogs and how-tos and comments from clients and things like that. So that's where the marketing, the business development efforts, spent from an organic growth standpoint. As we alluded to as well in the last couple of quarterly releases, we have started to shift some attention to M&A as well. We think that we're in the position, if we find the right target company, because of the scale, because of the ability to layer on business without really having to invest a lot more in the technology, we think it's the right time to start to look to see if we can identify some tuck-ins. So we're busy looking at that as well.
Okay. What's the size of your addressable market for specifically what you do right now?
On the advertising side, it's about $250 to $300 million on the ad distribution side. The music side of it is probably $3 or $4 million. So that really isn't a growth market or a big growth opportunity. The music side of the business actually over the last little while has been pretty robust and has been growing a little bit, which none of us saw coming. We thought that would also decline along with when the pandemic hit. But I think that because people aren't on the road and they're not touring, they're making music and they're sending it out to radio and TV. So that part of the business is robust. But we might see some moderate growth from that area of the business, but I'd say we've kind of got what we've got for now. And on the award show side of the business, we're very selective about the clients that we bring on board. We tend to go for the marquee award shows only. This is not a commodity business; it's a high-touch business. So again, I'd say the business we have is there's the opportunity to grow a little bit, but the ad business is certainly the growth opportunity.
Okay, well, good. You answered my secondary question, so that's really where you expect most of your growth is going to come from, is that part of the business.
Yeah,
okay.
And I say the 250 to 300 million on the distribution side. That's straight distribution. I mean, what we are working on as well is some additional service offerings just to try and broaden what we do. And again, it's all technology solutions. We're certainly not getting in the ad business. There's a lot of high touch production work that gets done. Not interested in getting into that. There's people out there that do it well, and the margins certainly are a lot lower than the margins that we have. But we are working on projects. There's things like clearance, and clearance is basically all of the approvals that the broadcasters require internally before a commercial gets aired on TV. So to make sure that it complies with language and make sure there's nothing offside with the spot itself. But that's a pretty cumbersome process at the broadcast side. So we're working on a technology solution for that. And each one of these will represent an opportunity to layer on a little, additional revenue from those core businesses, but more importantly, gives us chance again to market to clients on a broader, scope of services, and helps the core distribution business development efforts as well.
Mm-hmm. Good. Okay, I got a handful more questions. I just want to remind anybody if they've got any questions that they're interested in having answered here, please use the chat function, and I'll do my best to ask Gary. Gary, you added a couple new directors recently. Maybe just touch on some of your, those two new players, and give me a sense of who the rest of the management team are.
Sure. Yeah. We periodically, go through a sort of cycle of directors on the board, and I think, I think that's a pretty healthy thing to do. We've always had very, very supportive directors. For the most part, directors have been investors, and from time to time, people step off because they have other things that they want to do. And we look at sort of a fresh perspective on the board. So at the last AGM, we had Shep Boone step onto the board. Now Shep has been an investor in Yangaroo for probably 7 or 8, maybe even longer, 9 years. He is the biggest shareholder. Between the money that he manages and his personal holdings, he's responsible for about 20% of the overall shareholding. So, and he's certainly been a very, very supportive guy. He's participated in some of the debenture rounds and things like that over the years. And then Roy Graydon has stepped on as well. And Roy brings some excellent experience as well in terms of being an operator. He's raised financing, M&A, small tech, large companies. So, just a really good perspective, that I certainly welcome at the board level in terms of being able to, have discussions and have the board as a true resource, in addition to, obviously the governance role. Mm-hmm. So, those are the changes at the board level. In terms of the management team, we have head of advertising, Grant Schutrumpf. He's a lifelong advertising guy on the distribution and production services side of things. So he's a subject matter expert through and through, and he's been pivotal in attracting good people to the team and repositioning us, rebranding us, going out to the conferences, and really brought us credibility very, very quickly. And it's been responsible for bringing in some of the high profile clients. I mean, he certainly was responsible for bringing in the political business that we saw in Q1. Rich Closer is our CTO. He's been with the company well over 10 years. And Rich is responsible for everything, technology, both from the platform perspective and our internal, hosting, infrastructure, IT, support, all that kind of thing. Very, very smart guy. And unlike a lot of CTOs, he brings a combination of incredibly good technical, expertise with a business sensibility. So, we're not out there building things which are nice, shiny toys. Rich asks all the right questions about, can we monetize them? What's the real business case, the business use? And we come up with some pretty pragmatic solutions to things. So we're very lucky to have him. Adam Hunt runs our music business. He's been with the company well over 10 years as well. And music and the award show side of things. So he's done a pretty good job again trying to identify and capitalize on growth opportunities in the music business, which is a very mature business, obviously. And he's done a good job on that. And as I've said, when we expected our business to actually decline through this pandemic, we've seen it hold together with actually some moderate growth there. So some interesting things going on there. And then we have Dom Kizek, who's our CFO, and he joined us about 1.5 years ago. We had a part-time CFO and a controller prior to Dom joining us. But, with the company growing, the conversations we've been having with banks, some of the more complex things that we're working on around M&A and things like that, we thought it was time to have a more seasoned CFO in-house, and he's done a really good job, particularly with the banks and dealing with the government, quite frankly, through the pandemic on accessing some of the relief money which has been available.
Fantastic. Okay, I see here you've got roughly 60 million shares outstanding. Give me a breakdown, insider ownership. Maybe do you have any institutional ownership? Just break down the share structure if you can for us.
Yeah, I mean, institutional, well, insiders are around 25-26%. Institutional, around 25-26%, and then I'd say, all other, for the balance. Obviously with Shep Boone stepping on to the board, and his 20% comes in as part of the insider. So you'll see that the insider portion has grown. When Jerry Herlo stepped off the board and Shep stepped on, there was a net increase of about 10%. That was reclassified as insiders. So, roughly 50%, insiders and institutional, and the rest is pretty widely held beyond that. And I'd say for the most part, those institutional shareholders are buy and hold. So, we don't have a lot of liquidity around the shares, which is, good and bad. But, for the most part, the people that have come in on a holding because they believe, as obviously we all do, that the future looks pretty good for the company.
Right on. Okay, well, why don't we open up to some questions? I've got Dave asking, so what is it that you're actually adding in terms of value? Is it software engineering? Well, that's basically the question. Is it software engineering? What really are you adding over and above what I guess the industry's been doing for the last last couple of years or decades?
I mean, certainly if you look at, let's just look at the last couple of years. There are other competitors in the market who do the same thing we do. We believe that we have a very elegant technology solution. And the tech, I wouldn't say, that our technology solution is light years ahead of of anybody else's. There are some other, companies out there that have pretty decent solutions. I'd say where we are streets ahead of anybody else is our client service, and the support around the technology, because where this industry has fallen flat a little is having reasonably good technology solutions and then cutting back on the customer service side of things and catering to an industry on the ad side of the business, which is used to a lot of hand-holding. And that hasn't changed. So, typically a technology company will come in and say, we're solving a whole bunch of solutions. You're going to be able to slash a whole bunch of costs, get rid of a whole bunch of people. That's the logical approach to things. In the ad business, it's like, yeah, not so fast. We really want you to make our life easier. And the technology works wonderfully well, but actually we want some of your client service people to take over some of the manual parts of the process, which the agency clients used to do, which we are taking on. It's not overly burdensome for us, but we've stepped up in that area when others haven't. So, the technology solution is great. It's very robust. It's very, very scalable. But, what really differentiates us in the market is is customer service and attention to detail. And it's an industry that's moved away from that pretty dramatically from a competitive standpoint.
Earlier you had mentioned that you guys turn around, you know, a piece of content in an hour. Why is that important? Why, I mean, does the industry really need it in an hour, or is it just that you guys are so good at what you do, you get it done faster than somebody else?
You know, it's an interesting, you know, question. In the days when all of this was a manual process, and, you know, things were serviced out on, you know, DVDs or hard drives, and, you know, it took a week, then, you know, the agencies knew it was going to take a week. What's happened now is because the agencies and the brands understand, you know, that this is a technology flow through solution. You know, if you give somebody, you know, if you tell a person they have a week, you know, it takes a week. If you tell them it could take an hour, they give you an hour. And, you know, we saw that particularly, you know, in the political, you know, ad client that we had, where, you know, they would pull a spot and they would, you know, do last minute editing, or get a, you know, take a spot and say, you know, we need to get this, you know, spot into a different market or a different version. So it's become very, you know, advertising has become a very dynamic process, particularly, you know, with data analytics and AI. So spots are pulled and replaced with other spots and moved around pretty rapidly, and we have to be able to respond to that, which is why you need a robust technology solution. Now, you know, otherwise there'd be a bottleneck on the distribution side.
Mm-hmm. Now, so Dave's asked a question, and I'm going to try to paraphrase it here, but hopefully I understand what he's saying. When you signed up an ad agency, really at that point, more or less all their business is going to come to you. You don't have to sell them on a per project basis, correct?
We don't sell them on a per project basis usually, but when we sign up a client, we may get all of their business, but we may not. I mean, there are some clients who, as a matter of good business, don't want to be exclusive with one supplier, particularly on the distribution. And again, I'll use my courier analogy. If you might use FedEx and UPS and not just rely on one in case, you know, somebody breaks down or has issues. So there are clients where we do all of the business. There are clients where we do some of it, and, you know, there's some that we're sort of the secondary or backup supplier. So it all just depends. Typically, though, if your client is the agency and you distribute a brand, so in the case of we have an agency client, the brand is Toyota, we would distribute all of Toyota. So they typically don't split a brand. So you will get all of a brand, but you may not get all of the brands from an agency.
Right. Understood. Okay, well, another question here is, why are your margins so good? Obviously, 95% gross margins. Most companies would kill for anything close to that. You guys, obviously, you're software, so we recognize that. I'd almost say a bit of a SaaS model in that once you've got a client, they're going to keep sending you business. You don't have to keep selling them on it. But why? And like 95%, that's pretty outstanding.
Once again, we have the platform. That platform is built. We obviously maintain it, but our direct costs are some bandwidth costs, which are fractional pennies against an order, and sales commissions, and the odd bit of production work that needs to be done. So beyond that, we have our fixed overhead base, and once we broke through that overhead, we don't have to layer on additional overhead to support sales. So I mean, bandwidth is incredibly cheap. So the variable cost side of the business are minimal, and that's not going to change on a go-forward basis. I mean, if you look at where we've been over the last few years, the margins gross margins have been around that 95% level for a number of years now.
Yeah, fantastic. Okay, I'm going to take one more question, and this relates back to you mentioned M&A. What are you looking for in an M&A target? And can you describe your ideal acquisition target?
Certainly, and I've alluded to this a few times. The growth segment of our business is advertising, so we'd start there. I mean, it's a much broader playing field anyway. But our ideal acquisition target would be essentially, getting a company that's selling distribution services. They may do some distribution work on their own, because there are a number of companies out there about the same size as us. They don't have a full broadcast footprint, so they can probably, let's just pick numbers. Maybe they, can distribute 50% of the content themselves because they've built out a network over the years. They're not going to get the other 50%, so they use companies like ours to complete the distribution footprint. So we have this odd relationship in this business where competitors could be clients as well. Mm-hmm. And then, so to us, those are the kinds of businesses we would look at, where it would be essentially, picking up a book of business. It's a straight tuck-in. We wouldn't need any, to pick up any of the technology. Some key, relationships, obviously you want to, maintain, but on the back end of our business, on customer support and all the accounting and things like that, we have some room to absorb business there as well. So it really is a traditional, tuck-in, the book of business that we would look for on the ad side of the business. That would be the ideal one. And again, something that we, really don't have to do anything to other than, put that volume through the system and continue to drive the 95% margins.
I got to imagine you turn the tables around that your book of business could look pretty valuable to some of your competitors as well. So you could technically be an acquisition target as well, would you not?
Yeah, I mean, I say that everybody is a buyer and seller at any point in time. Sure. A buyer if you've got the resources, but anybody's a seller. Obviously, if there was an offer you couldn't refuse.
Sure.
But it's nobody's knocking on our door today. Some of the bigger players in our space, have been on pretty aggressive acquisition, sprees over the last few years. Some of them are pretty, extended. So, and obviously going, where business is now in the pandemic, I'm not sure anybody's, overly acquisitive right now. We're looking at it saying, we have a balance sheet that's pretty healthy, and certainly a business that's more than has the ability to absorb an acquisition. So we think the time's right.
Mm-hmm. Perfect. Gary, this is the time in the interview where we ask you to just give your final thoughts, or if there's one key message you'd like to have the audience really know about Yangaroo, please let us know. What can you tell us?
I'd say, we're the sort of little company, again, that punches well above our weight in an addressable market that gives us more than adequate room to grow with unbelievable gross margins. So, the future looks good for us. The business development side of things looks very, very promising. We certainly have some M&A opportunities, and we have a share price that doesn't reflect any of that. It's partially because we're a micro cap that's getting people's attention, partially because we have very supportive shareholders. We don't have a lot of, liquidity around the stock. But for a company like ours, $7.5 million, that's, got a profitable track record to be trading at less than 1x revenue. I think that this is an incredible opportunity. And again, a company our size is managing to hold things together through some pretty challenging times. And is even having a potential, conversations around potential M&A. It certainly gives you an idea of where our headspace is at. I mean, we're looking forward. We're not, we're not playing, gone into a defensive huddle. We're certainly playing both ends of the game. And, I'd encourage people to take a look at it. I think there's a bright future and some pretty dramatic potential on the upside if we get things right, which I think we can.
I would actually mention that I think your enterprise value is probably closer to $3.5 or $4 million. So you guys are trading well below 1 times, EV to revenue. So, so definitely worth looking at. If somebody wants more information, what's your website address?
It's Yangaroo.com. Pretty straightforward. I'd encourage you to go there and take a look. We've just relaunched the new website. I think it's pretty informative. If people want to reach out to me, my details are on the website. Send me an email, give me a call. I'm more than happy to answer questions, and I encourage people to keep an eye on us.
Perfect. Gary, I want to thank you for hanging out with us today. I think it's been definitely very informative. I think it's something we will continue to watch and look forward to seeing how you guys manage to, deal with the tough times we're in. Thank you so much. And at this point, I'd love to hand it over to Trevor to wrap up.
Thanks, Paul. Thanks, Gary. Before we wrap up here, Gary, what's if an investor would like to contact you or contact somebody from the company, what is your contact information, or what's the best way to do so?
Sure. Send me an email. That's probably the easiest right now. So it's gary.moss@yangaroo.com. And my cell number is 416-505-1771.
Perfect. Thanks, Gary. And we're looking forward to, following along the next set of financials and any updates that come from the company, and look forward to having you back again in the future.
Thank you very much. Thanks for having me.
Thanks, Gary.